All right. Today is Monday, February 7th, and this is a recap of the stock market activities today. Folks, I got a good one for you tonight, but I got some bad news too. Tonight's program is going to be shorter than usual, and the reason is I have other obligations to attend to. So we'll keep it short and sweet. This is the bad news. The good news is we got a lot of information to cover. So let's dive right into it. And here it is, in focus tonight. How about catching a falling knife? According to the experts, and by the experts we mean the criminals over at JP Morgan, because it seems like pretty much every single week now, JP Morgan comes out with a note, buy the dip, buy the dip, buy the dip. And what do you know? It turns out to be catch a falling knife, catch a falling knife, catch a falling knife. And when the so-called pros become so desperate, there is something fishy here. For example, today JP Morgan came out and said, buy stocks. Today's the day you gotta buy stocks because rate hikes are now priced in. Oh really? How do you know that? We're pricing in what? 130 basis points increase this year? That could go up, that could go down, depending on inflation. And we know that the geniuses over at Goldman Sachs and JP Morgan got it wrong from the get-go about inflation. Matter of fact, back in October of last year, both Goldman and JP Morgan came out and said you gotta buy the dip because inflation is seen as transitory. Oh really? But here are some of JP Morgan's greatest hits. And I'm going back just a few months ago. I could go back years just to show you how embarrassing the record of JP Morgan is. After all, this is the criminal organization that has been manipulating the treasury market, the commodities market, the precious metals market, the stock market. They've been laundering money for criminals. They've been stealing money from the elderly. Matter of fact, we call JP Morgan the laundromat after all of that money washing. But here are some of JP Morgan's greatest hits going back to October of last year. How about this one? JP Morgan says buy the dip in Facebook despite concerns over new App Store rules and regulations. And this was back on October 7th. Matter of fact, JP Morgan said buy the dip in Facebook as shares of the social media giant are set to rise as much as 35%. Now, if you listen to JP Morgan's call that Facebook will rise higher by 35%, here's what actually happened. Facebook went down by almost 32% since the call. Uh-oh. How about this one? JP Morgan says it's time to buy Zoom video after shares get cut in half from the thing highs. And if you listen to JP Morgan's call back in October of 22, or excuse me, the 22nd of October, 21, you actually went down a nice 51% or so. Great call. Another one. JP Morgan says it's time to buy the dip, arguing that the thing is entering a less dangerous phase after the Pokemon. And this is according to the doctors at JP Morgan. This call was issued on December 2nd of last year. And if you listen to the doctors over at JP Morgan's and you followed the call, you went down, a nice 7.7%. No biggie, right? All of us make bad calls once in a while. Another one. JP Morgan's top stock strategist Marko Kolanovic,
what a stupid son of a bitch,
tells investors to trust this bounce. And this was back in December 7th of last year. If you listen to Mr. Kolanovic, you went down almost 10% since then. Another one. Peloton stock keeps falling as JP Morgan analyst slashes price target but remains bullish. So he slashes the price target but remains bullish. Hey, your house is on fire. But there is no need to panic. It's cold outside. And if you followed JP Morgan's call back in January 5th that Peloton is still bullish, you went down about 28.5%. Not bad, right? Now, they made the pump that Amazon is buying Peloton, really? And they got you back to even. Not really, but hey, that's the best we can do. Another one in JP Morgan's greatest hits. How about this one? Buy the dip, says JP Morgan. Markets can handle higher yields. Isn't this what they said today? And they said it back in January 10th. And it wasn't just JP Morgan's strategists. They even got Marko Kolanovic, a twofer, to tell you to buy the dip. The market can handle higher yields. Don't worry, don't panic. It's okay, it's warm. We'll hold your hands. That's not a cliff, that's just the Grand Canyon. It's beautiful down there. Keep walking with your blindfolds on. And if you listen to JP Morgan's call in January 10th, you went down about 10%, not bad. How about this one? After all of these calls, here he comes again. JP Morgan's Marko Kolanovic is again pounding the table for stocks. When they say pounding the table for stocks, they mean he's having sex with the table. That's how desperate he is. He's banging tables 2 at a time. Players couldn't get a drink. And if you listen to the table pounder, you went down about 3% in what, like a week? Still not bad, it could work, but the point being is they've been pounding the table over and over and over and over again at JP Morgan. What's going on over there? Is JP Morgan holding a bag of some sort and they're trying to lure retail investors to catch a falling knife and hold the bag instead, perhaps? But JP Morgan, hey, you don't have to do all of that because the zombie retail investor will do the job for you. You don't have to pound at the table. That could be risky these days. The table could accuse you of sexual harassment, Me Too, and then you lose your job. You don't want to do that. The retail crowd is going to jump into a hall on their own with the blindfolds on, running Naruto style, heads first. Buy first, ask questions later. Matter of fact, don't ask questions at all. For example, the headline reads, retail investors poured $231 million into Meta stock as it tanked after earnings, the highest amount since 2018, the research firm says. And if you've been watching the market today, you know that Meta went down big today. So these $231 million, poof, gone. They're catching a falling knife. Retail investors shelled out $231 million to snap up heavily discounted shares of Facebook. Meta, we're not going to fall for that shit. During Thursday's sell-off, this is last week, the highest amount in nearly 4 years, according to Vanda Research. Facebook's parent company lost $251 billion in market capitalization as the stock sank 26% on Meta's fourth quarter earnings report, which showed daily users falling for the first time ever. The company also issued a tepid first quarter guidance, so the fundamentals don't add up anymore. Yet the retail crowd is programmed on autopilot like a bunch of zombies to buy the dip regardless, because they pay no attention at all to the fundamentals, to earnings, to the Fed's policy, inflows, outflows, institutionals, the technicals. That doesn't matter. In fact, retail investors poured more money into Meta shares Thursday than in the popular QQQ that tracks the Nasdaq 100 index of large cap growth stocks and the Lever Tech ETF ProShares Ultra Pro QQQ, meaning the TQQQs, which the retail crowd loves to buy. And perhaps the retail crowd needs to learn from what happened last year. We're not talking back in 99, the dot-com, 2007. We're saying last year. The headline from NBC reads, some investors saw their 2021 gains evaporate in a volatile start to 2022. Here's what they're saying now. Diego Flores, 20, said he started investing 2 years ago. He noticed the buzz about individual investors who sought to jump into a stock buying frenzy on Reddit and took action. Uh-oh. Mr. Flores says, I decided to put a little bit of money into GameStop and AMC just to see what happened. Surely enough, it started really going up, adding that he made $800 from the $4,000 investment in GameStop. 20, forgive me for the mispronunciation, but it's your fault. Your name sounds like a character from Games of Thrones. Anyways, he's also 20 years old and he says he saw the earnings potential in Wall Street bets, but said he stopped short of investing. He says the GameStop stock kept going up and up, and they were talking about AMC. So when I tried to invest in some call options from AMC, Robinhood actually canceled my call option. And that made me very upset. And I guess it made a lot of members of the community upset. The start of the new year brought a swift market correction that wiped out much of those gains. January was the worst on record for stocks since March 2020. Flores says his assets are struggling. They're not doing particularly great, especially given that I decided to take out more risk recently. Oops. And just like looking to grow stocks, penny stocks, and so that did not end particularly well, Flores said. Others, like Narayanan, feel it has been a relatively upsetting few weeks through the market correction. He also added, it will continue to fall most likely, but I planned on holding these things for the long run. So this is just turbulence in my portfolio. Ever heard of the so-called turbulence of buying Cisco, Intel, Microsoft at the top of the dot-com bubble? You had to wait over 20 years to get to even. So if you mean by the long run, waiting 20 years to get to even, then you better wake up, pal. Some new traders, like self-proclaimed, quote, baby investor, Kara Khan, 23, who started investing about 3 years ago, says she believes the market will recover. Honey, you're 23. You haven't seen a real market correction. You haven't seen a real bear market. You haven't seen what happens when the Fed starts tightening the monetary policy. So how could you assume that the market is just going to recover? It might recover 20 years from now. Who knows? She also added, when the market dips, people panic and they continue to sell, which continues to make it dip more and more. If you really believe in something, just hold on. As the crypto community says, like hold on for dear life, aka hoodle. How's the hoodling working so far in GameStop, AMC, Peloton, Zillow, Plug Power, Nikola, all of the garbage that the retail crowd has been buying? I'm actually more excited about the market drops, more than anything because that presents me an opportunity to buy and hold, says Mihir Wadikar, 21. He also added that he started investing in 2020 and is now self-employed at his own cryptocurrency startup. What happens after the crypto crash? McDonald's, right? He said he was willing to tolerate the market drops knowing he can continue to buy in and wait for the eventual rise. Again, it could rise tomorrow, it could rise 3 weeks from now, or it could rise 20 years from now, as we've seen in the dot-com bubble. And oh, by the way, a lot of stocks during the dot-com bubble, the hot stocks, ceased to exist. They're no longer here. You know why? They went bust. And here's the sad part. Others, like Flores, are not as optimistic. He said, I'm thinking of completely selling off just to let this pass, especially because, again, I'm not really well versed in how this works and just kind of seeing how it unfolds and learn a little bit from it rather than learn and lose all of the money that I've made. And I say out of all of these people, Flores is probably the one who's going to turn out to be a great investor in the future. Why? Because he has the humility. He wants to learn. And let me say this, the biggest mistake that your generation can make is, and we're talking about investing, of course, the biggest mistake is wanting to get rich quick. If you invest in the stock market, wanting to get rich quick, in all likelihood, you're going to lose all of your money. And here's why. If you want to get rich quick in the stock market, you buy the riskiest assets, meaning penny stocks, high beta stocks, speculative stocks. You buy way out of the money call or put options with weekly expiration hoping that you're going to win the lottery. In other words, you're gambling, and 99% of gamblers end up losing money. Trust me, I used to work in a casino, watching gamblers all night long. 99% lose their money. Why? Because they're taking unnecessary risk. Once you remove the toxic thinking of getting rich quick out of your system and you start investing for the long run with discipline, yes, there is always a degree of risk that comes with the territory, without saying. But in the long run, if you're disciplined, if you follow the fundamentals, the technicals, the earnings, and you construct a portfolio, a stocks portfolio, and then you use a portion to trade options or perhaps invest in more speculative stocks, a portion of your portfolio could be 10%, could be 5%, could be 25%, depending on your age. A small portion of your portfolio goes into chasing risk, but the majority of your portfolio should be for the long run. If you use this strategy in the long run, you're gonna achieve financial independence. But joining the stock market with the mentality of wanting to get rich quick, you're just depending on luck here, and luck is not a strategy. Now, the problem with your generation is, and it doesn't matter how old you are, by the way. When I say generation, I mean those who joined the stock market, who started investing during the pandemic, after the drop of 2020. The problem is you got spoiled. You folks got spoiled. You've seen the market in a hyper mania bubble, with stocks blasting higher, doubling, even tripling in a matter of weeks. And you're now programmed to think that the stock market in regular times acts this way. The truth is, it doesn't, because under normal circumstances, the stock market is actually boring, just like today, no major moves whatsoever. But over time, the compounding effect is what makes you rich, not chasing the hot trade. The good news is, is you're still young. Who cares if you lose your money? Doesn't matter. You're going to build your money again. And now you can invest in the stock market with better knowledge. When I started investing and trading, I was a teenager and I did the same mistakes. It was a bubble, it was a hypermania, and I chased the hot trades, the penny stocks, weekly call options way out of the money. And guess what? I scored big, the biggest score in history. I was a teenager whose overnight was sitting with a massive amount of wealth. I couldn't even believe it, and I thought I'm a genius. Warren Buffett. Who cares, right? I'm the new Warren Buffett, bitches. And what do you know? Fast forward, I lost it all. And I mean all, everything, gone, poof. Now that will shake your system to the core. You're going to feel stupid. You're going to fall into depression. And you're not going to believe the stock market anymore. You're going to say, you know what? The stock market is not for me. It's rigged. It's for the rich. Yada, yada, yada. In the meantime, in reality, you lost your money because you're stupid. That's why. And being stupid is okay when you're starting investing in the stock market. The question is, are you going to learn and become better and make a comeback like I did or not? And making a comeback requires a lot of discipline. And that is the message of the day. And lastly, before we move on, when we talk about the Fed's policy, look at this. Valuations matter, folks. Valuations always matter. Yes, we can have a few months, perhaps years, when the stock market becomes irrational. But sooner or later, the chickens will come home to roost. Because when valuations get out of whack, it's an indication that we have a bubble, an assets bubble. Sooner or later, the Fed will have to tighten the monetary policy to control the bubble and inflation. And the higher the valuations, the higher the risk when the Fed starts to tighten the monetary policy. Well, when we look at the valuations right now for the S&P 500, we are at 22.8. Which is the second highest reading in terms of valuations since the dot-com bubble in 1999. What happened then when the Fed started tightening? The dot-com bubble imploded and we saw the crash of 2000. You put two and two together, in all likelihood, we're going to see a crash and valuations will come down to the mean. And it's going to be painful. What goes up must come down, specifically when it goes up on no fundamentals, no rationale, and no supporting macro. Now, that doesn't mean that you have to abandon the stock market altogether because the Fed is tightening, because there are corners in the stock market that continue to outperform even when the Fed is tightening. There are other markets, international markets, that could outperform even when U.S. markets go down. There is always an opportunity out there, but you gotta follow the fundamentals, and this is why in this show we cover earnings. Because by looking at earnings, you can find out which companies are performing in this macro environment that we have, including inflation, or which stocks are not performing. And then you combine the earnings report with the valuations, with the technicals, and you come up with a rational conclusion, whether to invest in a certain stock or dump it. Speaking of, let's look at some earnings that we got today and preview some of the earnings that we have this week. Today, we got a report in the morning from Tyson, a company that I called in this show as an inflation hedge. And the reason is meat prices continue to move higher, and Tyson has the pricing power and the receptive consumer to battle inflation. Matter of fact, to benefit from inflation. Listen to what I said about Tyson back in November of last year. Let's start with Tyson. And folks, remember this. We're looking for companies with the pricing power and the receptive consumer, because this dynamic of pricing power and a receptive consumer is what companies need to withstand this inflation storm. If you're not exercising your pricing power or your consumer is not receptive to the increase in prices, you're not an inflationary company. You're not an inflation hedge kind of stock. So let's see if these companies have the pricing power, whether they're exercising the pricing power, and what about the consumer? Are they receptive or not? Starting with Tyson. The sales for Tyson were up 12% year over year. The operating income was a stunning 98% increase year over year. And all in all, the bottom line, the net income, was up a stunning, a mind-blowing 207% year over year. So why did Tyson experience all of these great results in the last quarter? The answer is pricing power. For example, the volume of sales for beef, pork, and chicken were all down year over year, but the average prices were significantly higher. And therefore, the revenue, the sales for Tyson shot up higher. For example, beef prices were up 32.7% year over year. For pork, prices were up 38% year over year. For chicken, prices were up 18.7% year over year. Once again, transitory. Mr. Powell? When we look at the operating margins for Tyson, beef is the best producing segment with almost 23% growth year over year. And then we have pork 4.7%, and chicken were down 3.5% year over year. Here's what Tyson needs to do. They need to continue to jack up prices higher for beef and pork, but specifically pork, to compensate for the weakness in chicken, because chicken prices did not go higher. You can still have nuggets for now. Who knows how long would that last? But for now, the inflation is happening in beef and pork prices primarily, and therefore Tyson has to jack up prices even higher. Exploit the opportunity while you still have it. And this is exactly what Tyson did. They moved prices higher because they can, because inflation is moving higher, and the consumer remains receptive. The consumer has no other choice but to pay the extra cost. What are they going to do? Not eat? Yes, they're exploiting the advantage, but why not? If inflation is rising higher, if you can push prices higher beyond the extra cost that you're incurring, and the consumer remains receptive, then what is the harm? Of course, the harm is that the poor, the middle class, their spending power will go down, and they will indeed suffer from higher inflation. That is not Tyson's fault. This is the Federal Reserve's fault, printing money out of thin air, pushing demand out of whack to the point where it overwhelmed the supply chain. And here it is. Everybody's screaming and yelling. The stock market is crashing. Everything is crashing. I'm losing money. Look at the chart of Tyson, a monthly chart. All-time highs. We have a stock that just reached all-time highs while everybody's running and screaming that the market is crashing. Why? Because the fundamentals don't lie. Now, let's see what we have in tomorrow's reports. We have Pfizer, the criminals over at Pfizer. The headline reads, Pfizer, the thing, cash pile opens opportunities for deals. They made so much money from the jabs, they can buy an entire company now. So I hope that the jab cult is proud of themselves, right? Because they turned this country into a tyranny. Cancellations all over the place, censorship, yada, yada, yada. And guess what? With all of that, cases went to all-time highs. Do you know what else went to all-time highs? Pfizer profits. You fools. You became salespeople for Pfizer for free. They did not even pay you. If I'm going to pump the jab, they better pay me. But you geniuses pumped for free. But here's the problem with Pfizer's earnings. The third shot, I don't want to say the name because the robot police would go crazy, but only 50% of those who are eligible to get the third shot got it. What does that mean? There is a good probability here that Pfizer's earnings are going to disappoint, so be careful here. We'll also have Peloton. All eyes will be on Peloton because on Friday we saw a pump from the Wall Street Journal saying that Amazon might be buying Peloton. Really? Why would Amazon buy Peloton? It's a liability. And I smell fake news. Just like the Samsung Biogen news, just like the Wall Street Journal just a few weeks ago when they came out with the recycled news that GameStop is joining the NFT market and the stock shot up on Friday after hours. We already knew that. We also heard from Hertz buying soufflés, and I called it in this show, fake, not true. The numbers simply don't add up. There's something wrong here. And guess what? We now know that this was fake. Hertz did not order thousands of soufflés. It didn't happen. It was a pump. So who's to say that this is not another pump where they came out today and said, oh, even Apple might be buying Peloton now. Why would they buy Peloton? It's a liability, folks. Why would Nike buy Peloton? It doesn't make sense at all. And by the way, Peloton is not cheap. It could get cheaper. So who's to say that this is not a manufactured pump before the earnings report so the insiders and the executives can get out at a higher price? We'll see. And then we have Harley-Davidson. This will be important too because it is a pulse for inflation. Harley-Davidson was one of my picks in the Biden portfolio, and since then, it went higher by almost 100%, and then it came down. Is it a buying opportunity? Who knows? But the charts are not looking good. What I'm seeing right now is a formation of a head and shoulder. Now, understand this. The earnings report is about fundamentals, so it doesn't matter what the charts look like. If the fundamentals come out good, the stock will move higher. If they come out bad, then the stock is going to move down. Yet the technicals are important in assessing the risk, meaning you look at the chart and you see a stock that moved higher, already made a top, made another attempt to make a higher high, and it failed, meaning that the fundamentals that we already have for this name, past earnings reports, are not enough for dip buyers and investors to buy this stock. Now, could the new report coming out tomorrow change all of that? Yes, it could, but it's a high bar. Harley has to beat by a lot for the stock to move higher. And the last thing I want to say before I move on to charts, I'm going to make a video reviewing a lot of earnings that we got so far. We're done with almost 50% of corporate earnings. So I'm going to make a video going over the major earnings. We're going to assess the fundamentals, the valuations, the technicals, and I will tell you during those videos which stocks I'm adding to my portfolio, which stocks I'm dumping out of my portfolio, and better yet, which stocks I'm shorting. But please be patient and bear with me here because it's a one-man operation and it takes a lot of time to produce these videos. And with that, folks, let's move on to cover the charts. We start with the 30-minute chart of the SPY. Nothing major happened today, and the reason is the chart remains trading in a range. The support at 447, the resistance at 451, and the magic number is 444. If that number is violated and SPY closes the day below that number, then we're going down to retest the line in the sand, 430, and in all likelihood, it's not gonna hold. Notice that the chart tried to climb 451 and it failed today. It's not a major rejection, but it is alarming. Why couldn't the chart move higher? We did not have any news. We did not have any negativity. Bitcoin was moving higher. The 10-year yield was stable. Yes, it moved higher, but not impulsively. So why couldn't the buyers show up in the SPY? My hunch is, psychologically speaking, market participants are waiting for the CPI. Nobody wants to assume the risk ahead of the CPI reading. You buy now, what if the CPI comes out too hot and rate expectations move higher and now you lose your money? You don't want to sell either, you don't want to short because what if the CPI, the cooks at the bureau, give us a cold reading and now we have to push down those rate expectations and the market blasts higher? We are in a wait and see mode. On top of that, by the way, today I was hearing the news and they're saying that the invasion of Ukraine is imminent any day now, and that is adding to the hesitancy of dip buyers. What if we wake up tomorrow and Russia already invaded Ukraine overnight? That will rattle the market, and perhaps the only safe bet for now is cash and energy. Moving on to the daily chart for the continuous contract for the SPY. The bulls are in the clear for now. Why? Because the support of 4,472 is intact. The moment that support is violated and the chart closes the day below that number, then the bulls lose all hope and the bears gain significant advantage. Why? If the support of 4,472 is violated, in all likelihood, the momentum indicators, which are now working in the bulls' side, they will turn negative again, and hence the bulls will be left with nothing. The volume is not on your side, the momentum indicators are not on your side, and oh, by the way, the chart pattern is also not in your side. But so long as the support of 4,472 is intact, you got a lot of case here. You got the momentum indicators, you got the chart pattern, you got the support lines. And oh, by the way, what if this is a bull flag consolidation and the chart is going to pop higher and it recaptures 4,549.5 as support? It could happen. But the moment you lose the support of 4,472, that hope is over. What about the Qs? 30 minutes chart. What's going on here? Again, within a range. The support 352, the resistance at 360. The bulls better hope that we see a retest of 352 and that holds, because if it doesn't hold, the chart will go down to retest the line in the sand at 343, and in all likelihood that's going to fail. And I know what you're going to say. You're going to say, why would you say that a retest of 352 is bullish? Shouldn't the bullish scenario be recapturing 360 as support? Yes, it would. But better yet, how about retesting 352 as support? And if that holds, then now we have a confirmation that we got solid support. We got a floor at 352 that we can work with. But right now, we only retested 352 twice. Let's give it another shot, a third shot, and see if it's going to hold. And if it doesn't hold, then you better find that now before you buy above 360. And then what do you know? The chart flushes down anyways. What about a daily chart for the continuous contract for the Qs? Again, we can do the same exercise here. That the support of 14,445 is critically important because losing that support means that the bull flag formation is out of the window. That also means that a pattern of an ABC formation is not going to happen. And that will come hand in hand with the momentum indicators, the RSI and the MACD indicator crossing to the negative territory. So once again, the most important number is 14,445. For now, the bulls have a case. It's a solid case, by the way. They got the momentum indicators, they got the volume moving down, slowly but surely. They got the support lines intact for now. There was a good case for the bulls. But losing that support takes that case and throws it out of the window. What about the IWM 30 minutes chart for the Russell 2000 small caps? Similar story here. It continues to trade within range. The support at 196.5. the resistance at 204.5. In all likelihood, looking at the chart right now, we need to go down and retest 196.5 for support and see if that holds or not. We're better off doing that before the CPI, because let's say the chart move higher ahead of the CPI and it recaptures 204.5. Then the CPI comes out hot and the chart flushes down and it violates the support of 196.5. We better know if 196.5 is going to hold right now before the CPI. So once again, the bulls better hope that we run a retest and it holds. What about the Dixie? What's going on here? Flat, no activities at all, and the reason is we're waiting for the CPI reading. A hotter CPI means that the Fed will be more hawkish, and a more hawkish Fed means a higher US dollar. What about gold? The old man. It is working its way to remove the bear flag pattern, but that's not going to happen. Gold will not be out of the woods until it recaptures 1,835 once again. Absent of that, the bear flag remains on the table. And just like we talked with the Qs, the SPY, the IWM, the gold bugs better hope that the bear flag will play out. Why do I say that? Because if the bear flag plays out, then we're going to know for sure whether the support of 1,763 is solid or not. If we move down there and it holds again, that will be tremendously bullish for gold. But if we go down there and it fails, then we better know that right now and get it out of the way. What about a daily chart for the 10-year yield? Again, moving higher, not by a lot. We're facing the resistance at around 1.94. And of course, the psychological target becomes 2%. Everybody's eyeing 2%. If they move the 10-year yield all the way to 2% before the CPI, then there is a risk for bears here, because the CPI could indeed come out hot, but maybe on par with expectations. And that will be good enough to drop the 10-year yield. And that will initiate a pop higher in the NASDAQ. Folks, once again, this is a game of expectations. The bulls better hope that we're heading into the CPI bloody and bruised, because expectations would be in the toilet. How bad can it get if we're already pricing 5 interest rate hikes? If we are already pricing 50 basis points hikes in March, if the stock market is down 5% before the CPI, then how bad is it going to get? In all likelihood, the opposite is going to happen, and the market will recover and pop higher, and vice versa. If the market, let's say, the next few days moves higher impulsively, 2, 3, 4%, then the risk for disappointment becomes more likely. Moving on to the TLT, a weekly chart, what's going on here? We're now below the support 140. In all likelihood, we're going down to 134.5. And that could come hand in hand with the 10-year yield reaching 2%. Again, if you're buying the dip in the TLT, you're taking a lot of risk here, because it is a psychological goal to push the 10-year yield higher to 2%, be it before the CPI or after the CPI. So you're better off waiting for the CPI reading and then decide whether to buy the dip in the TLT or not. What about the VIX? 4 hours chart, we have conflicting messages here. On one hand, the MACD indicator is showing slowing down of the momentum in the VIX, meaning that the VIX could go down to close the gap, and if it doesn't bounce from that point on, then it's going to go down to retest 20 as support. If that happens, the SPY is going to pop higher. That bull flag pattern will play out, and the SPY will pop higher. Now, you could also argue that the VIX is setting up a trap for market bulls here. It might be playing dead, but watch out, the MACD indicator is still showing green impressions on the histogram. The chart of the VIX is still trading above 20. The chart of the VIX is perhaps gathering energy, forming another ABC pattern to the upside this time around. There are no guarantees here, and therefore, the line in the sand for the VIX chart is the gap. If the gap is closed, which is around 22 by the way, so watch out for the VIX here. If it moves below 22, then in all likelihood, the SPY will take another leg higher, and we're going down to retest 20. But if the VIX closes the gap at 22 and then it rebounds higher again, that is an ominous sign that the VIX is not done moving higher. And that comes hand in hand with the fact that the SPY is not done moving lower. What about the VXN, the VIX for the NASDAQ? 4 hours chart once again. The MACD indicator is still showing red impressions on the histogram, but the VXN is still holding at elevated levels. And perhaps what we're seeing so far is the formation of a bull flag, which will mean an incoming pop in the VXN and another leg down in the Qs. So the message is, for NASDAQ bulls, you gotta watch the VXN carefully. My number is 27.5. If the VXN closes the day below 27.5, then you're good to go. In all likelihood, the NASDAQ will move higher. But if the VXN continues to trade above 27.5, then you're not out of the woods yet. Keyword yet. Now, speaking of conflicting signals, look at this. Apple, a daily chart, it is forming a bull flag pattern at around the support of 172.4. The question is this bullish or bearish? The answer is it is bullish for now because we're seeing a bull flag pattern. But we're also seeing a bull flag pattern in the VXN. We're also seeing the 10-year yield moving higher. We're seeing the chart of the Qs from a 30 minutes perspective not looking good, at least for now, perhaps running down for a retest at 352. Yet on the other hand, you have Apple, the biggest stock in the market, forming a bull flag pattern. Everybody's waiting for the CPI. We have conflicting messages here, meaning be careful on betting one way or the other right now, specifically via options, because you have no clue how the market is going to react after the CPI reading. For now, speaking for myself, I am an observer this week. I'm gonna wait for the CPI reading before I make a decision one way or the other until and unless one of the important support lines that we talked about is violated. And here is the hourly chart for the Souffle Tesla. No update here, still trading within range, but pay attention now. Look at the implied volatility in the big caps. In the majority of technology stocks, the implied volatility is too high, meaning the risk versus reward is not worth it. You buy calls, you buy puts, you're paying top dollar for the premiums here. Meaning, if stocks remain flat for a few days until the CPI, moving that implied volatility down, you're gonna lose money. It doesn't matter whether the stock that you bought calls or puts on moves in the right direction or not. Yet when we look at Tesla's implied volatility, it is actually suppressed, believe it or not. So the opportunity here, if you do believe that volatility is not done yet, and we will see another massive leg up or leg down, then the opportunity is in buying Tesla options because they're cheap. But they're only cheap if you believe that the implied volatility is about to move higher again, specifically in Tesla stock. A lot of traders, when they anticipate higher volatility to come in a certain stock, but they're not certain in which direction the pop will happen, they open straddles and strangles trades, meaning buying calls and puts. Look it up. So this could be a good strategy in Tesla stock right now. I do have puts. I might open calls, but I'm not sure. And believe it or not, I bought the puts last week. And even though Tesla moved a little higher and it remains consolidating within a range, the premiums on those puts actually moved higher. Why? Because I bought them when the implied volatility was down. So if the implied volatility in Tesla continues to move higher, these put options will continue to appreciate so long as we don't see a massive pop in the stock. And hence, I'm saying, if you are expecting that the implied volatility in Tesla is about to pop higher, but you're not sure whether the stock is going to pop higher or drop down, look into strangle and straddle strategies. And lastly, what about tulips, BTC? What's going on here from a daily chart perspective? Somebody bought the dip, and we know who that is, and we're now moving above 42,000, recapturing that level of support. In all likelihood, Bitcoin will go down and retest 42,000 for support. But let's read the psychology here. We saw a bear flag pattern at around 35,750. And I told you back then, the chart was asking any buyers, any buyers, any buyers. If I cannot find buyers, I'm flushing down to 30,000. Perhaps I can find buyers over there. All of a sudden, the buyers showed up. So what does that mean? It means that the buyers been there all along, but they've been hesitant to buy the dip in BTC. They were looking at each other. Hey, you going first? How about you go? No, how about you go? I'm not going. How about you go? And nobody wanted to go until Senator Ted Cruz decided to go so he can pay the hookers on OnlyFans. And now everybody thinks, oh, a senator bought the dip in Bitcoin. Maybe he knows something that you and I don't, so let's buy now. And as you can see, BTC popped higher. The psychology is important. But now we're going to have another challenge. In all likelihood, Bitcoin will consolidate awaiting the CPI reading. It's going to consolidate around 42,000, forming what it could be a bull flag pattern, asking any more buyers, any more buyers, any more buyers. If the buyers don't show up by the CPI reading, or after the CPI reading, I should say, then the chart will flush down. And between you and I, let's hope that that's going to happen. I mean, wouldn't it be nice if Senator Cruz ends up holding the bag here? Think about it. Anyways, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Most importantly, we have the Small Business Index, and this will be important because it is a pulse. It is a leading indicator of the upcoming CPI reading. We need to see how small businesses are feeling about inflation. What are they saying about inventories? What are they saying about the supply chain? What are they saying about energy prices? What are they saying about wages? All of these will be important inputs to the upcoming CPI reading. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.